Hey there everybody, welcome to this episode of Working Class Finances. I know that trying to get into investing at the very beginning can be really intimidating. There's a whole bunch of new terms to learn. You have to learn about stocks and bonds, what kind of accounts to keep them in, what dividends are. There's a whole lot of stuff to learn and it can be really overwhelming. And you might want to just bury your head in the sand, pretend it doesn't exist and hope things will work out in the end. But once you get going, it's really not that bad. So today we're going to start off easy. We're going to talk about stocks and bonds. We're going to talk about what they are, why you would want them, and the advantages and disadvantages of both. All right, let's get to it. So first up, we'll start with stocks. Really simply, buying shares of stocks means you're buying partial ownership of the company that you're buying. Now, for the most of us, this would be a very small percentage of the company that you're buying shares in. If you take Microsoft, for example, you could spend $1 million buying shares of Microsoft stock, and at that point you would still own less than 0.0001% of the company. So don't expect that you're going to own a large portion of any company that you're buying stocks in. So that being said, it can still be a good thing for us to own even our very small portions of these companies. So if we take Microsoft, for example, right now they're trading at about $230 per share. So if we buy 10 shares of that stock, it'll cost us about $2,300. So if Microsoft does well, their stock may go up in value. Say it goes up to $250 in value. Now the 10 shares that you bought for $2,300 are now worth $2,500, leaving you with a $200 profit. But you want to keep in mind that you only get those profits from those shares of stock if you then sell those shares when they're at a higher value. So another reason that you may want to own stocks is that some companies will pay out a dividend for each share of stock that you own. This is always expressed as a percentage per year that they pay out to everyone who owns the stock. So with the Microsoft example, they pay out 0.97% in dividends each year. So if you own $2,300 worth of stock, over the course of the year, they'll pay you about $22 in dividends. Now, earning $22 a year in dividends is not much, but over time, as you invest more and more in these companies, your dividend income will grow more and more along with that. One thing to keep in mind for dividends is each company will pay different amount of dividends. Some companies may not pay dividends at all. And just because a company is currently paying dividends does not mean they will always pay dividends or that it will always be the same amount. There were a lot of companies that a year ago were paying dividends. Then when the pandemic hit, their income went down drastically and they had to cut dividends. So stocks generally have a higher return than bonds do, but to go along with that, they're also riskier than bonds are. So earlier we talked about buying Microsoft for $230 a share, and then the value going up to $250 a share, and our $200 profit on that. It is also possible for us to buy a stock at $230 a share, and then for that share value to go down, which would mean we would lose money on that investment. Now again, just like the profits, you don't actually lose that money until you sell the stock. So one thing to remember for the stock market is there are fluctuations, it will go up and down. So just because a stock has a temporary drop down does not mean it will automatically keep going down. And just because the stock goes up doesn't mean it'll always keep going up. Another thing to consider is that if the company you're invested in goes bankrupt, likely all the shares that you own will be worth nothing. So now we're going to talk about bonds. Bonds are basically you giving a loan to a government or a company. Someone may issue bonds to fund research and development for a new project. They may want to build buildings, they may want to build roads or parks or work on local infrastructure. There are all kinds of reasons that bonds are issued. So just like when you get a loan for, say, a car, you agree with the bank that you'll make X dollar payment each month for this many years until that balance is paid off. A bond issued by a government or a corporation works basically the same way that the auto loans do. For each bond that you own, they agree to pay you X amount of dollars each month for a predetermined amount of time. And just like the car loan, they are going to pay back the original balance that you gave them, plus some interest. So bonds can be issued by local governments, state governments, the federal government, or corporations. So bonds generally have a lower return than stocks do, but they're also generally a safer investment. So if you remember with stocks, you're buying a piece of that company, and the value of those shares are tied to how well the company does. With a bond, you're giving a loan to this company or a government, and they're paying you that money back, but with interest. So the reason you would want to have bonds in your investment portfolio along with your stocks is if the stock market has a bad year and the prices go down, generally the bonds will still be paying interest to you, and receiving that interest can help minimize the damage to your portfolio for those years when the stock market is down. Another possible benefit to bonds is the income that they generate may be tax-free depending upon where you live and what kind of bonds you're buying. So bonds issued by the federal government are most likely not going to be subject to state income tax. And municipal bonds, depending upon where you live and what ones you buy, may not be subject to state, local, or federal income tax. Now, with anything dealing with taxes, you always want to make sure to do your research beforehand. The last thing you want to do is skip out on paying your taxes and having to deal with the IRS any more than you need to. Now, there are a couple downsides to bonds as well. I've already mentioned that they generally have a lower rate of return, and they are not risk-free. Much like individuals, governments or companies can default on paying their loans. But this risk can be mitigated by doing some research on the government or corporation that you are buying the bonds from. So that is it. I hope that helped you learn what the difference between stocks and bonds are and why you might want to own some of them. Just a quick recap. With stocks, you are buying partial ownership of that company, and the value of that investment is tied to how well that company does. And bonds, you are giving a loan to that company, and they are paying you that money back with interest. Bonds are generally a safer investment but have a lower rate of return, and stocks have a higher rate of return but have more risk associated with them. I think that both stocks and bonds have a place in your investment portfolio. I own stocks and bonds in mine. The ratio of stocks to bonds that you have will be determined on what your goals are, how aggressively you want to invest, and your current investing situation. Alright, so that's it for the discussion about stocks and bonds today. Please like this video and subscribe to the channel. And if you have anything you'd like me to cover in the future, please let me know in the comments. I'll see you next time. Bye.